Speculation is the practice of engaging in risky financial transactions in an attempt to profit from fluctuations in the market value of a tradable good such as a financial instrument, rather than attempting to profit from the underlying financial attributes embodied in the instrument such as capital gains, interest, or dividends. Many speculators pay little attention to the fundamental value of a security and instead focus purely on price movements. Speculation can in principle involve any tradable good or financial instrument. Speculators are particularly common in the markets for stocks, bonds, commodity futures, currencies, fine art, collectibles, real estate, and derivatives. Speculators play one of four primary roles in financial markets, along with hedgers who engage in transactions to offset some other pre-existing risk, arbitrageurs who seek to profit from situations where fungible instruments trade at different prices in different market segments, and investors who seek profit through long-term ownership of an instrument's underlying attributes. History. With the appearance of the stock ticker machine in 1867, which removed the need for traders to be physically present on the floor of a stock exchange, stock speculation underwent a dramatic expansion through the end of the 1920s. The number of shareholders increased, perhaps, from 4.4 million in 1900 to 26 million in 1932. Speculation and investment. The view of what distinguishes investment from speculation and speculation from excessive speculation varies widely among pundits, legislators and academics. Some sources note that speculation is simply a higher-risk form of investment. Others define speculation more narrowly as positions not characterized as hedging. The U.S. Commodity Futures Trading Commission defines a speculator as a trader who does not hedge, but who trades with the objective of achieving profits through the successful anticipation of price movements. The agency emphasizes that speculators serve important market functions, but defines excessive speculation as harmful to the proper functioning of futures markets. Financial speculation is unproductive and sterile in economic and human terms, and so is guilty of encouraging all those factors that leads the economic system to its ruin. Gambling in general and stock market speculation in particular constitute the basis of unproductive speculation. Unproductive speculation can be criticized in a moral context. According to Ben Graham in The Intelligent Investor, the prototypical defensive investor is one interested chiefly in safety plus freedom from bother. He admits, however, that some speculation is necessary and unavoidable, for in many common stock situations, there are substantial possibilities of both profit and loss, and the risks therein must be assumed by someone. Thus, many long-term investors, even those who buy and hold for decades, may be classified as speculators, excepting only the rare few who are primarily motivated by income or safety of principal and not eventually selling at a profit. Economic benefits. Sustainable consumption level. The speculator Victor Niederhofer, in The Speculator as Hero, describes the benefits of speculation. Let's consider some of the principles that explain the causes of shortages and surpluses and the role of speculators. When a harvest is too small to satisfy consumption at its normal rate, speculators come in, hoping to profit from the scarcity by buying. Their purchases raise the price, thereby checking consumption so that the smaller supply will last longer. Producers encouraged by the high price further lessen the shortage by growing or importing to reduce the shortage. On the other side, when the price is higher than the speculators think the facts warrant, they sell. This reduces prices, encouraging consumption and exports and helping to reduce the surplus. Another service provided by speculators to a market is that by risking their own capital in the hope of profit, they add liquidity to the market and make it easier or even possible for others to offset risk, including those who may be classified as hedgers and arbitrageurs. Market liquidity and efficiency. If any particular market, such as pork bellies, had no speculators, Only producers and consumers would participate in that market. With fewer players in the market, there would be a larger spread between the current bid and ask price of pork bellies. Any new entrant in the market who wanted to trade pork bellies would be forced to accept a liquid market and might trade at market prices with large bid-ask spreads, or even face difficulty finding a co-party to buy or sell to. A commodity speculator may profit the difference in the spread and, in competition with other speculators, reduce the spread. Some schools of thought argue that speculators increase the liquidity in a market, and therefore promote an efficient market. As more and more speculators participate in a market, underlying real demand and supply can become diminishingly small compared to trading volume, and prices may become distorted. Without speculators, it is difficult to create an efficient market. Speculators are there to take information and speculate on how it affects prices, producers and consumers, who may want to hedge their risks. Near counterparties, if they could find each other without markets, it certainly would happen, as it would be cheaper. The benefit of price discovery provided as a byproduct by speculators is of great benefit to the economy as a whole as well. Bearing risks. Speculators also perform a very important risk-bearing role that is beneficial to society. For example, a farmer might be considering planting corn on some unused farmland. However, he might not want to do so because he is concerned that the price might fall too far by harvest time. By selling his crop in advance at a fixed price to a speculator, he is now able to hedge the price risk, and so he can plant the corn. Thus, speculators can actually increase production through their willingness to take on risk. Finding environmental and other risks. Speculative hedge funds that do fundamental analysis are far more likely than other investors to try to identify a firm's off-balance sheet exposures, including environmental or social liabilities present in a market or company but not explicitly accounted for in traditional numeric valuation or mainstream investor analysis. Hence, they make the prices better reflect the true quality of operation of the firms. Shorting may act as a canary in a coal mine to stop unsustainable practices earlier and thus reduce damages and forming market bubbles. Economic disadvantages. Winner's curse. Auctions are a method of squeezing out speculators from a transaction, but they may have their own perverse effects by the winner's curse. The winner's curse is, however, not very significant to markets with high liquidity for both buyers and sellers, as the auction for selling the product and the auction for buying the product occur simultaneously, and the two prices are separated only by a relatively small spread. That mechanism prevents the winner's curse phenomenon from causing mispricing to any degree greater than the spread. Economic bubbles. Speculation is often associated with economic bubbles. A bubble occurs when the price for an asset exceeds its intrinsic value by a significant margin, but not all bubbles occur because of speculation. Speculative bubbles are characterized by rapid market expansion driven by word-of-mouth feedback loops, as initial rises in asset price attract new buyers and generate further inflation. The creation of the bubble is followed by a precipitous collapse fueled by the same phenomenon. Speculative bubbles are essentially social epidemics whose contagion is mediated by the structure of the market. Some economists link asset price movements within a bubble to fundamental economic factors such as cash flows and discount rates. In 1936, John Maynard Keynes wrote, "Speculators may do no harm as bubbles on a steady stream of enterprise. But the situation is serious when enterprise becomes the bubble on a whirlpool of speculation." Keynes himself enjoyed speculation to the fullest, running an early precursor of a hedge fund. As the bursar of the Cambridge University King's College, he managed two investment funds, one of which, called Chest Fund, invested not only in the then emerging market U.S. stocks but also periodically included commodity futures and foreign currencies. To a smaller extent, His fund achieved positive returns in almost every year, averaging 13% per year, even during the Great Depression, thanks to very modern investment strategies, which included intermarket diversification as well as shorting volatility. According to Zimba and Zimba, Keynes' risk-taking reached cowboy proportions, 80% of the maximum rationally justifiable levels, with overall return volatility approximately 3 times higher than the stock market index benchmark. Such levels of volatility, responsible for his spectacular investment performance, would be achievable today only through the most aggressive instruments. He chose modern speculation techniques practiced today by hedge funds, which are quite different from the simple buy and hold long-term investing. It is a controversial point whether the presence of speculators increases or decreases the short-term volatility in a market. Their provision of capital and information may help stabilize prices closer to their true values. On the other hand, crowd behavior and positive feedback loops in market participants may also increase volatility at times. Government responses and regulation. The economic disadvantages of speculators have resulted in a number of attempts over the years to introduce regulations and restrictions to try to limit or reduce the impact of speculators. Such financial regulation is often enacted in response to a crisis, as was the case with the Bubble Act 1720, which was passed by the British government at the height of the South Sea Bubble to try to stop speculation in such schemes. It was left in place for over 100 years until it was repealed in 1825. Another example was the Glass-Steagall Act passed in 1933 during the Great Depression in the United States. Most of the Glass-Steagall provisions were repealed during the 1980s and 1990s. The Onion Futures Act bans the trading of futures contracts on onions in the United States. After speculators successfully cornered the market in the mid-1950s, it remains in effect as of 2013. Update. Food security. Some nations have moved to limit foreign ownership of cropland to ensure that food is available for local consumption, while others have sold food land and depend on the World Food Programme. In 1935, the Indian government passed a law allowing the government partial restriction and direct control of food production. It included the ability to restrict or ban the trading in derivatives on food commodities. After independence, in the 1950s, India continued to struggle with feeding its population, and the government increasingly restricted trading in food commodities. Just at the time the Forward Markets Commission was established, the government felt that derivative markets increased speculation, which led to increased costs and price instabilities. In 1953, it finally prohibited options and futures trading altogether. The restrictions were not lifted until the 1980s. Regulations in the U.S. Following passage of the Dodd-Frank Wall Street Reform and Consumer Protection Act, the Commodity Futures Trading Commission has proposed regulations aimed at limiting speculation in futures markets by instituting position limits. The CFTC offers 3 basic elements for their regulatory framework: the size of the limits themselves, the exemptions from the limits, and the policy on aggregating accounts for purposes of applying the limits. The proposed position limits apply to 28 physical commodities traded in various exchanges across the U.S. Another part of the Dodd-Frank Act established the Volcker Rule, which deals with speculative investments of banks that do not benefit their customers. Passed on the 21st of January 2010, it states that those investments played a key role in the financial crisis of 2007 to 2010. Proposals. A number of proposals made in the past to try to limit speculation that were never enacted. The Tobin tax is a tax intended to reduce short-term currency speculation, ostensibly to stabilize foreign exchange. In May 2008, German leaders planned to propose a worldwide ban on oil trading by speculators, blaming the 2008 oil price rises on manipulation by hedge funds. On 3 December 2009, a representative, Peter DeFazio, who blamed reckless speculation for the 2008 financial crisis, proposed the introduction of a financial transaction tax, which would specifically target speculators by taxing financial market securities transactions. Books. Covell, Michael. The Complete Turtle Trader. HarperCollins, 2007. ISBN 978061241,703. Douglas, Mark. The Disciplined Trader. New York Institute of Finance, 1990. ISBN 0-13-215757-8. Gunther, Max. The Zurich Axioms Souvenir Press. ISBN 0-285-63095-4. Fox, Justin. The Myth of the Rational Market. HarperCollins, 2009. ISBN 978060598,990. Lefebvre, Edwin. Reminiscences of a Stock-Operated John Wiley & Sons, Inc., 2005. ISBN 0471678767. Neil, Humphrey B. The Art of Contrary Thinking. Caxton Press, 1954. Niederhofer, Victor. Practical Speculation. John Wiley & Sons, Inc., 2005. ISBN 0-471-67774-4. Sobel, Robert. The Money Manias. The Eras of Great Speculation in America, 1770–1970. Beard Books, 1973. ISBN 1-58798-028-2. Patterson, Scott. The Quants, How a New Breed of Math Whizzes Conquered Wall Street and Nearly Destroyed It. Crown Business, 2010. ISBN 9780307453372. Schwartz, Martin. Buzzy. Pitbull. Lessons from Wall Street's Champion Trader. HarperCollins, 2007. ISBN 978061844,638. Schwager, Jack D. Trading with the Market Wizards. The Complete Market Wizard Series. John Wiley & Sons, 2013. ISBN 9781118582978. Tharp, Van K. Definitive Guide to Position Sizing. International Institute of Trading Mastery, 2008. ISBN 0935219099.